2022 has been a bad 9 months for investors in stocks and bond markets globally. While our investment team had expected our first market correction since the COVID bottom this year, investors have suffered the first broad-based bear market in years. Stocks have round-tripped 2 years of gain through the end of the third quarter, which, while common during Fed rate increase cycles, isn't enjoyable. What's the culprit? Treasury bond interest rate increasing at the fastest pace in decades during a normally weaker midterm election year amid slowing growth. These things have combined to crunch risk assets. In the last 4 weeks, the Federal Reserve interest rate increase path has been so fast that it's stressing and breaking esoteric parts of the financial markets. Much as Alan Greenspan's doubling of interest rates caused the Mexican currency crisis in late 1994, Chairman Powell's race higher in interest rates is causing stress in other countries and other assets beyond our shores, most notably in Britain, amongst UK pension funds and the British currency, the pound. What's notable is that both these rapid rate hiking cycles happened in front of midterm elections. I'm Chris Paris, Chief Investment Officer with Oak Harvest Financial Group, and this is our investment team's midweek release when we examine a news item, headline, or story making the rounds from publicly available sources. Yay! And we ask, is it news or is it noise for your money? This week, we talk about midterm election year seasonality in the stock market. So looking back, these Fed rate increases, they were both cycles that were efforts to stave off inflation. And both rate cycles look to be peaking in momentum around the same time of the year, in the fourth quarter, after financial markets suffered 10 to 11 months of decline. As we've discussed in previous videos, midterm election years tend to be sloppy, choppy messes for the first 3 quarters of the year. On average, US midterm election year declines are a little over 20%. 2022 is slightly greater than 20%. Its decline is putting it in the standard decline during midterm election years. That deserves a Charlie Brown ugh. Ugh! The average and median midterm year corrections for the S&P 500 are minus 20.8% and minus 19.8% respectively, according to Merrill Lynch. Viewers, but there's good news. Lower prices often lead to higher, longer-term returns and quite often large multi-month and multi-year recoveries. According to Steve Suttmeyer at Merrill Lynch, the month of October is the month of the year when the biggest market lows and bottoms are made. Throughout history, not just 1 or 2 years. 8 out of the 17 biggest rallies ever started in lows that took place in October. And 13 out of the 17 biggest rallies of all time started in the second half of the year, June or later. So far, year to date, mid-June and early October are looking like low water marks for the year. History would say we're in the time window for better returns. Viewers, listeners, we're not talking about 5 or 10% moves. We're looking at longer-term buy and hold moves that lasted 13 to 93 months and averaged almost 4 years. The best part of the presidential cycle is from the midterm year low, usually in late third quarter like we are right now, through year 3 of the presidential cycle. Rallies off the low into year end can be strong, and they've averaged returns of 17.6%. The potential for a sharp year-end rally in 2022 is aligned with the path the S&P 500 has usually taken after the Federal Reserve begins a rate hiking cycle. A cycle which should be approaching peak hawkishness and peak momentum. Take a look at the historic data for those who are interested. Year to date, we followed very similar patterns to 1962 and 1994. Over the last 70 plus years, stocks have always had a positive return 1 year after midterm elections. The average return has been almost 15%. Previously, we've discussed that stock markets tend to be largely indifferent to the results of US elections. The market's favorite outcome, though, is a split government and the predictability that gridlock brings. This is news for your investment. News that says, historically speaking, the market should be entering a time when there are fewer headwinds and more tailwinds, not for days or weeks, but for months or quarters. Year 3 of a new presidential term, which would be 2023, has been the best annual turns for periods studied back to 1950, posting an average gain of over 20%. Viewers, there are no guarantees, but history does have a tendency to repeat itself. Are you trying to meet your needs or your greeds in retirement? Give us a call here and schedule an initial consultation with an Oak Harvest advisor. That advisor will sit down with you and help you and your family do the math to figure out if you'll be able to meet your retirement goals and your needs. At Oak Harvest, we think our clients are best served by us helping them plan for their future needs instead of focusing on the past. The future is always uncertain, and that's why our advisors and retirement planning teams plan for your retirement needs first and your greed second. Give us a call here to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. I'm Chris Paris, and from the whole team here at Oak Harvest, have a blessed week.